Listen to part of a lecture in an economics class.
Trade has become increasingly global in recent years, with many countries exporting and importing various products. Globalization has led to a resurgence of interest in trade restrictions and policies, in conjunction with market access. There have been contrasting views and positions that vary considerably on how restrictions on international trade can cause economic harm. Countries often increase exports by adopting trade protectionism. This can insulate domestic companies from global competition for some time, as tariffs will be imposed on imports to make goods more expensive. However, the problem with this economic strategy is that other countries will soon do the same and retaliate, bringing about a trade war that will consequently hurt global trade in the long run. This trade war can lead to a global recession, and in some worst cases, a global depression. Therefore, maintaining a good balance between import and export is essential for a healthy economy. Some will argue that imports should be regulated to protect domestic unemployment. However, what is interesting to note is that increasing import does not necessarily cause harm. Both import and export bring job opportunities to the local economy. Importing goods can give low and middle-income countries a chance to boost their economy, produce higher quality products, and gain revenue by bringing new products to their local economy. Likewise, imports allow greater diversity in the market for consumers, since they can purchase foreign products without having to travel to other countries. The benefits of import extend beyond consumers to businesses. Importing goods can allow local businesses to create a valuable niche in their local market, as these businesses can become the primary local supplier of a specific product. Of course, there are advantages of export that we should also consider. The benefits of export include job creation and greater opportunities for businesses to grow in international markets. There is distributed risk, which means there is less risk, since businesses can sell their products to a variety of consumers that are outside the local economy. If the local economy is suffering under crisis, countries that are involved in international trade can still profit from their international customers. Though exporting goods boosts the local economy and increases revenue, it has some disadvantages that should not be ignored. Excessive exports can result in depleting natural resources and goods, such as crude oil and petroleum, which leads to inflating prices and limiting the availability of necessary products for countries that are heavily reliant on these exports. But we will cover this topic, looking at the disadvantages of import and export in our next class.
Question 7. What is the lecture mainly about?